The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Looking at the market trade after Tuesday's session, a bit of consolidation after the strong day we saw on Monday. Maybe not as much follow through as we anticipated in some parts of the grain and livestock trade, but nonetheless, an okay day on Tuesday. Here to walk through things with us, we welcome in Jim McCormick with agmarket.net. Jim, always good to catch up with you, sir. I hope things are going well in Chicagoland. Thanks for joining us today.
Thanks for having me, Jesse. And yeah, things are going well. We are having a weather roller coaster here. Last week we were in the 80s. There was some ground that was worked up. A little bit of beans were planted before the snow came. And yes, we did get snow here in Chicago Sunday night into Monday, warming up midweek. Got big rains coming in middle of the week. And then we're talking freeze potential by the weekend. So at least in this part of the state, planting has pretty much ground to a halt again.
Well, that's the weather roller coaster of the spring sometimes that we have to fight and combat with. It'll be interesting to see just how long this weather pattern maybe keeps us out of some fields here across parts of the Corn Belt. I think that's going to be watched closely. Maybe some of that you were mentioning to me played a role in Tuesday's trade action, maybe a little unwinding of some of the bull spreads you kind of mentioned to me before we jumped on the air here. What's your overall take just with some of the trade we saw across grains on Tuesday? Felt kind of consolidation type trade in nature, Jim.
It's definitely kind of a consolidation type nature. I mean, if you look at the corn, Jesse, I mean, we've had a nice little rally, 15, 20 cents off the lows. So if you want to be a buyer of it, you're probably got to risk the near-term lows. And then on the other hand, if you want to be a seller of it, technically, I think you got to at least risk to around the 585 level, if not a little bit higher, closer to 6. So we're a little bit in no man's land. So I think a lot of today was more positioning. The option expiration is on Friday. Then you got first notice day next week for the May contracts. The May contracts were a little bit under pressure. We saw a lot of people buying the old crop, selling the new was kind of a popular trade recently because, you know, the tight older supply that we've seen, China buying, the crush was phenomenal crush. That number came out yesterday, was a very good crush. So that was keeping a bid under the old crop. But the new crop, we saw some pressure on ideas that, hey, we're going to get this crop planted off at a very quick pace. At least that's what it felt like. Planting progress last night that came out did come in at 8%. It was lower than the average trade guess. Same thing for beans for the most part. So I think with this cooler weather we're anticipating, we're still talking about flooding problems in the northern plains. The southern plains are still waiting for that crucial rain event. It felt like that was reason enough to see a little bit of liquidation of those bull spreads and maybe putting a little bit of weather premium back into the new crop pricing.
Well, thinking about this corn market too, just in general, we look at, you mentioned the old versus the new crop spread action in December, getting up around that 570 level here. While I know a lot of bids, at least I've heard this chatter, a lot of bids have rolled already from May to July corn. So look at July corn, for instance, that 640-ish range, 645. It's kind of interesting watching these charts, Jim, here in this corn market and just thinking about, getting this crop in the ground and some of what you mentioned, buying the old, selling the new kind of thing. There's been just a lot of interesting movement, so to speak, in this corn market here as of late, kind of with what you're talking about there, Jim. It's been interesting to watch, I guess, is the point that I'm trying to make.
I think it's been interesting to watch. I think in general, that trade is probably going to be a relatively good trade to kind of keep an eye on. I mean, the reality is this old crop carryout is very, very tight. How tight is it ended up being is going to depend on, we've been selling a lot of corn lately, but we got to get it shipped. But we are into that main shipping region. season, excuse me.
Mm-hmm.
And the other thing we got to keep an eye on is what's going on in the Ukraine. I mean, will Putin shut down that grain corridor? So that with that tight old crop scenario, that should keep a bid under it. Now, what's interesting is, like you mentioned, if you're pricing grain right now, you're pretty much pricing off the July contract, although May is still on the board. May options go off on Friday. We start delivering next week. May's trading around a 30-cent premium to July. Well, traditionally, wherever the May corn contract goes off, the July tends to go back to where the May is, because that's where value is at delivery. And so all things equal, if nothing changes, July looks undervalued, and that should help grind that old crop July up. The new crop, on the other hand, is just going to try to balance on what kind of acreage we end up getting. I mean, I think, there was a question about how many acres we'd actually get planted due to all the snow in the northern plains. Although talking to clients in that part of the world, the snow melt maybe is a little bit quicker than they thought it would be. Flooding maybe isn't quite as bad as they feared. We'll see. But the other thing is we got to keep an eye on is yield. Statistically speaking, we are going into, there's a high probability we are going to go into El Nino year. And out of the last 17 El Nino years, 14 of them ended up with trend or better corn yields. So if the weather cooperates, you could argue that we have a trend or plus corn yield. If you have trend plus corn yield with 91.5, 92 million acres of corn, you're looking at a 2 billion corn carryout, which if the market is focusing on that, that'll keep pressure on the new crop, as it's saying, hey, by late fall, we're going to have plenty of supply, especially if Brazil has this big safrinha crop. But in the meantime, this bridge from old crop to new crop is going to be relatively tight, and that'll keep a bid under the July contracts potentially.
You mentioned Ukraine. I want to just bring that up for a second. I know that ties into the corn and wheat markets most specifically. I know there was an announcement of a deal for Ukraine grain to move through Poland, but obviously the grain initiative, if this doesn't get renewed, there's a lot of skepticism out there about it, which we've seen this before, Jim. We've seen the skepticism and then a deal comes around. So I think until we actually see physically something move, it's kind of just a wait and see on the grain initiative. But that deal to move grain through Poland feels like at least a little bit of a bright spot to maybe tame some of the worries. What's your thoughts on that whole situation?
Well, yeah, I think it's kind of important. I mean, what Jesse's talking about, folks, is, essentially Poland and Romania were kind of frustrated because, when they had the war, before the war, a lot of the grain out of the Ukraine folks just pretty much went out the Black Sea. Start of the war, they started moving the grain back through Europe. And what the problem was, some of that grain wasn't making it all the way to Europe. It was getting to Poland, and it was stopping in Poland and stopping in Romania, which was depressing the local farmers' prices. And they were complaining to their governments that, hey, you're killing us price-wise. So what Jesse's pointing out is we now have a deal, at least the Polish have a deal that says the grain can move through Poland, it just can't get offloaded. So it is a thoroughfare, and that's it on its way to Europe. So that solved one crisis, but the real crisis I think we've got to see is what Putin's going to do about this grain deal. Remember the last grain deal agreement, what was it, back about a month ago, there was a debate of was it a 90-day deal or is it a 120 or a 60-day deal or a 120-day deal, as I recall. Okay, the Russians said it wasn't as extended as long as the Ukrainians. Well, the reality is right now the Russians are very frustrated. It's not shipping the grain out, it's the banking systems, it's the fertilizers, it's the economic sanctions that they're trying to get out from under. And I don't think the West is going to do that. I think they're going to try to keep putting the pressure on. So I think my personal opinion is that there is a real probability this time around that Putin may not, may call the markets bluff and may actually say, hey, we're going to walk away from the grain corridor. And then that just puts more risk. Now, grain may be able to move out of that part of the world, but it's going to get a whole heck of a lot more expensive to convince a shipping crew to go into a war zone. And we'll see. It's just my opinion, but I don't think the market believes he will do it because he's cried wolf twice now, saying he's going to do it, and he ended up not following through. But remember, a lot of people didn't think he was going to invade Ukraine. They said, he's just bluffing. Mm-hmm. And he invaded Ukraine. So I think you got to be a little bit cautious. And if that would happen, it would be tragic for the world. Let's face it, because you're going to take some supply of grain off the world market if that happens. But the reality is that probably would cause a spike in U.S. prices because it will force grain demand that would normally go go to the Ukraine and enforce it back in the United States. Because right now there's just not a lot of corn in the world at this point in time. So if they need corn, they're going to have to come to the U.S. market.
We're having a conversation today with Jim McCormick of agmarket.net. Jim, just going on the wheat market a little bit as well. We talk Ukraine, Russia. We obviously have drought worries in the southern plains when it comes to the hard red wheat. We have the worries about getting a spring wheat crop planted in the northern plains with the snowpack still melting up there. So you throw some of the weather concerns, I think, on top of the potential with the Ukraine grain deal and this wheat market. Already U.S. wheat's not very competitively priced on the world market, but if people have to come to the U.S. for wheat, we see a spike. There's a lot of potential what if in this wheat market in front of us here over the next 60 days, Jim.
I would agree. I mean, right now, the hard part's getting this wheat planted. I talked to a customer in North Dakota today, said it may be a month before they can get into some of those fields. He just said, we'll see. But he said, I'm just trying to be realistic. Then you talk to clients. We have clients down in Kansas, Western Kansas, say, they've had appraisals put in at less than 9 bushels an acre. We have other clients that are telling us, rain at this point we're almost getting past the point that it's really going to do any good. So you got a drought in the southern plains. You're facing too much rain in the northern plains. And, soft red wheat crop looks pretty good. But the reality is we're kind of dancing with Jack Frost here. We got another bout of cold weather coming in this weekend. So we'll see what happens with that. So this wheat market is far from certain. The Chicago wheat is way, way under pressured by the funds. If you look at the CFTC report, I'm sure you talked about it on a report on yesterday, the funds are carrying this huge short position in the wheat. So if you give them a reason to get out, be it a frost, be it not getting the wheat planted, be it the drought talk or the grain corridor being shut down, we could get ourselves a pretty good bounce on all the wheat complexes if the funds choose to liquidate that short.
Well, let's talk a little bit about the soy complex as well here. We haven't touched on that a whole lot yet, Jim. Good day on Tuesday's trade for beans. Bean oil had a decent day as well. I know I saw a report out there, a potential diesel deal between Saudi Arabia and Brazil to produce diesel with soy oil. I wonder if that had an impact in the bean oil market. But as you look at the charts and you watch this soy complex as a whole, any other takeaways that you're keeping an eye on here throughout soybeans right now?
Well, right now it's an interesting situation. The soybeans, the dynamic on the international market is we're expensive. I mean, if you're buying for value, you're going to buy Brazilian beans. That is the reality. Brazil's got the beans. They're cheap. But, if you want prompt shipment or maybe a certain quality of beans, I've heard a lot of people say that the Chinese like to buy our beans for their grain reserve because it's a better quality and it stores better, plain and simple. So you'll find China will buy beans, even though we're more expensive, because it's like I said, they're buying it for the reserves. So that's kind of keep us in the export game. But the reality is that crush number that we came out, the NOPA crush number, so one of the best crushes we ever had. The crush margins are great. It's going to continue. And that should help keep a bid on the market. And part of the reason why the crush is so strong is Argentina's crop is just, the reality is it's a disaster, Jesse. I mean, there's just no other way to put it. I mean, right now, if you think it's tough farming in America right now, think about trying to farm in Argentina. You have a half a crop and you got inflation running at 100%. I mean, it is an absolute economic disaster there. Now, they are going to crush some beans because they're going to get them from Brazil. They're getting them from Paraguay and all that. But the reality is they're not going to be able to crush as much beans as they normally do. That's going to tighten that meal supply in the world. And that's going to drive more demand for meal from the U.S. potentially. And that's also going to keep those crushers profitable and keep that crush going, which should provide some support for the old crop beans. New crop beans, they're going to lag a little bit because of, it's going to be an argument. If we can't get the corn in the northern plains, do they move the beans? So the beans may lag a little bit just on that argument. But the old crop, just like the corn, we've got a very tight carry out. The demand, the market's goal right now is to continue to kind of ration out demand, and they won't do it by breaking prices. So the steady to higher seems kind of the traditional way to ration demand out.
Overall in the grains and livestock too, watching the economy, the latest with just inflation and everything we're watching as far as the Fed and interest rates and more, and all these various earnings reports and indexes coming out here. Or what's your take on just the current state of the economy, the dollar, how that is playing into our commodities here as we look at the trade mid-April, Jim?
All right, now that is a very loaded question you just gave me, so I'm going to pick it apart. The dollar overall is weakening, it looks like, and I think a weakening dollar is bullish commodities traditionally. When our dollar gets lower, the products we export get cheaper, so that's a good sign. That's the one thing we're looking at. So that works positively in our agriculture or economic, commodity favor. As for inflation, the jobs numbers continue to be stout. That is the reality. Overall, the economy still, is still doing relatively well. It's interesting. I saw some stat that said something like 69% of the people believe the economy is in trouble. Okay? So you're like, wow, that's really negative, right? But then Delta Airlines just came out this week and said summer travel is going to be the best ever, potentially, way ahead of pre-pandemic levels. Well, it's a weird dynamic. You've got people telling people how bad everything is, but the reality is what drives our economy is consumer spending. And if consumers continue to go on vacation, continue to, do upgrades to their house, put on that deck, whatever it be, if they continue to do it, they'll keep the economy going a little bit strong, which is good for the overall economy, but it's frustrating for the Fed because the Fed in a way is trying to slow down the economy to get inflation under control. So it really is a very mixed picture on kind of how you look at it. Credit card debt, the headline is, it is at all-time highs, which is a negative sign. But on the other hand, credit card utilization is actually not as high as it was even in 2019. So the numbers are really kind of perplexing. I think in general, it looks relatively well, in my opinion, at least now. But I think if you are a producer out there, be it corn, beans, wheat, livestock, whatever it is, you want to take the opportunity to make sure you lock in profits because there are such mixed signals in the marketplace. Anything can change, can change in a heartbeat, plain and simple. But right now, if I got to make an argument, I'd say the economy is doing okay. It's not great, but it maybe is not as bad as some people fear at this point. Like I said, just going off what people are saying, as long as they're spending money, that's good for the economy.
I love a good loaded question. You handled that one well, Jim. Hey, before we wrap up, we should touch on the livestock trade too. Cattle, I didn't see as much follow through in cattle on Tuesday as I maybe would have liked to have seen. And then hogs, looks like we just kind of gave back what we made on Monday. So your take in this protein sector overall, Jim?
The hogs are struggling to put a bottom in. Hopefully we're getting close to it. We're going back down, giving back the near-term low. Hopefully we can hold last week's lows and you can argue a little double bottom's been made. The hogs look very, very cheap. The reality is this economy is very complex. There's a group of people in the economy, unfortunately, they're struggling very, very mightily right now. Pork looks like it's going to be a very good value buy. So hopefully that'll put a bottom in. The cattle, on the other hand, it's the same story. The supply continues to tighten in the big picture. We are seeing tightening supplies. We've seen that for the last couple of months. It's now up to the consumer. Does he continue to buy it? Can he keep pushing that beef price up? But it's going to be a little bit interesting situation, Jesse. I've talked to two different clients today that were talking about producers in the plains that are starting to liquidate, heifers and all that right now. This drought, essentially they got to the situation where they kept waiting for the spring rains to green up the grass, and it just has not happened. And it's forcing cattle to market and maybe a little bit clip. And that may put a little bit of pressure on the cattle near term if we end up seeing kind of a liquidation of this herd due to the drought. Now we'll see. Some of the model maps are trying to argue rain's got to come into that part of the country here. We'll see what happens. But, the overall trajectory of the cattle market is going to be the consumer. Is the consumer willing to pay up this premium? The cattle market will keep going. But if you get to the point where the consumer says, enough's enough, I can't afford it, this cattle market could see a nasty correction.
Jim, always appreciate the insight, and I know you guys have a lot of great resources available for producers. If they have questions, if they want to talk to you or anyone on the agmarket.net team, what's the best way, Jim?
Best way to reach us is call us either any of the Ag Market brokers at 844-424-6758 or go to agmarket.net to sign up for our research, or go to agmarket.app to sign up for our app.
Jim, thanks so much for the time as always, and we appreciate you being on the show. We'll talk to you again real soon. Have a great week.
You too. Thanks for having me on.
Jim McCormick, agmarket.net, our guest today here on Market Talk. That's all the time we have for today's show. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.